So the government has created a new investment account for children that goes from birth until 18 years of age. And these are sometimes known as a Trump account. Well, part of that account for children born between 2025 and 2028 is that the government's going to be able to provide a $1,000 seed fund to help start these accounts and to help fund these initial accounts. So there are all kinds of issues that relate to tax, such as what are the tax consequences when the government actually makes that contribution? What happens when a parent makes a contribution? Can the parent's employer make a contribution to the child's account? And then what happens when the child goes ahead and makes a withdrawal from the account? Now, that's going to be one portion of this video, but what I really want to do is make sure you understand these fundamentals. Then I want to talk briefly about the IRA, the Roth IRA specifically, and I want to talk about how these Trump accounts and the Roth IRA actually work together in order to optimize your child's after-tax consequences so you can deal with the financial planning for your children where they're optimizing both opportunities and both investments. So we're going to go ahead, we're going to walk through these and make sure that you are able to go ahead and plan for your children's financial future by maximizing their after-tax consequences. So let's get started. So the first thing we need to do is we need to recognize that when we're talking about these accounts, the child tax accounts, if the child was born between 2025 and 2028 and they are eligible for a social security number, then what happens is the child can have $1,000 deposited through the government. That's $1,000. Now that's free money. So you don't want to turn away that $1,000. Now here's the thing with it. It's not tax free. It's still great that we get $1,000 for our child, but it's not tax free. So what will happen is the child's not going to report income as they receive that money, and the parent's not going to have to report income, or the guardian won't be reporting income. But what will eventually happen is that money is going to go ahead and it's going to continue to create more money, right? It's going to continue to have compounding investments, and eventually what's going to happen is that $1,000 maybe worth, say, $80,000. Well, the initial $1,000 that the government is contributing does not have a basis in that amount. Because it doesn't have a basis, what the child will do is when they eventually withdraw that money, they now have to pay taxes on all of the funds, the initial $1,000 plus all of the interest that occurred throughout the process. So everything is going to be taxed on that. So when it says you don't have a tax basis, that's what they're referring. And you're going to pay taxes at your ordinary tax rate. Now, here's the next thing associated with it. When the parent goes ahead and makes a contribution to the account, the parent doesn't get a tax break for making that contribution, right? It was still included in the parent's taxable income. The parent took that money and the parent then goes ahead and makes a contribution into the child's account. Now, when the parent's making that contribution into the child's account, the child does get a basis in that amount that was contributed. So make sure you're keeping records that shows how much you have been contributing every year. Now, the maximum that you can go ahead and contribute is going to be $5,000 per year. Okay, so it's $5,000 per year on that. And again, it's not going to be something that you get to deduct on your taxes, but your child's not going to be including it in their taxes. Instead, what happens is, you put the money in and it continues to grow tax deferred. So during the entire process, when interest and compounding and everything else is going through, then once they take that out, they have to pay taxes on the interest component, on the growth of their investments. Okay, so that's the second part of it. Now, when we're looking at this contribution portion, there's a new fringe benefit that an employer can also do. So an employer can also contribute to your child or your guardian's account, and they can contribute up to $2,500, and it's not going to be taxable to you as the parent, right? So it's going to go into the account. It's great for the child. They're getting that money. It's great to be able to get a benefit to an employee without it being a taxable benefit, kind of like when we're looking at things like paying insurance premiums and those other types of things. So this is a great benefit that can also be used. Now that $2,500 contribution, that goes toward the $5,000 maximum per year that can be contributed by the parent into the accounts. Okay, So then the other thing I wanted to mention as we're looking at these accounts is that with the account, it is not limited to just children that are newborns, right? So you do have that $1,000 that will be limited, right, for the government to make that contribution. But this can go all the way up until the child is 18. Now, I mention that because I want you to know that there's no earned income requirement on it. So the child doesn't have to have earned income in order for the parent to go ahead and contribute it. So this opens it up to a much younger group than you would have had with a Roth IRA type of situation. Now, what will happen, like I said, when the child goes ahead and makes distributions from there, now the child's going to have to pay taxes on it, and they're going to be paying taxes at their ordinary tax rate because we eventually start to treat it like an IRA. And now we're going to also have withdrawal dates. If you take out an early withdrawal instead of waiting, then what happens is you're going to have to pay a 10% penalty in addition to having to recognize that tax on income. There's some exceptions to that, but that's your general rule. Now let's compare that to your Roth IRA. So if you have that Roth IRA, what happens is the parent's not getting a tax break. So the parent earns the money. The parent's going to go ahead and now they're going to contribute into the child's account. Well, that's great, although we've been taxed with it. But now that it's in the account as a Roth IRA, right? Now that we have a Roth IRA and we put it into this account, a Roth account, then what's going to happen is that's going to continue to grow. It's not going to be taxed, so it's not just tax deferral. It will never be taxed. Again, you're paying taxes up front. So that $1,000, if it grows up to $80,000, guess what? The child's not going to have to pay taxes on any of that $79,000 of growth if you did a $1,000 contribution on it. So it's a huge benefit. Now, the other things with it. So it's not only going to be growth free, tax growth free. Let me be clear on that. The other things that are going to happen is this does go till 59 and a half in order to avoid different types of penalties associated with it. So this is a long-term play. You're looking more toward retirement. Again, there's some exceptions, but you're generally looking more toward retirement with this type of account. If you are thinking, hey, I want to go ahead and I want to provide for my kids so that way they can go on to college, I want to pay for their college, your plan would be, instead of using the Roth portion, so when I give you the strategy, it's not going to be using the Roth portion. What we're going to be looking at is going to be using a 529 plan. And the 529 plan is purpose focused. It's on educational expenses. So there's a difference between if you're looking at retirement or if you're looking at college education. All right. Well, let's go ahead and start looking at some of the plans that we can use in order to maximize performance for your child. Okay, I also want to mention real quick when we're talking about the Roth IRA, a couple things I didn't talk about on that last portion of it. So when you're looking at that Roth IRA, first off, the child has to have earned money. They have to have earned income. It could be from self-employment, so they're a babysitter, or it could be from working for another person. They're working at a grocery store. Either way, hey, they're going to have some earned income. So if you're going to make a contribution to a custodial Roth IRA for your child, they must have earned income. The second thing is the amount of the contribution. When we talked about the new child investment accounts, well, we said there's that $5,000 limit as a general rule. Now, what's going to happen with the Roth is it is going to be the lower amount. So the limit is a lower amount of either $7,000 or the amount of earned income that the child has. So if the child's just babysitting throughout the year, maybe they earn $2,000, the maximum that you can contribute over to the Roth IRA is going to be that $2,000. If they're working and they made $12,000, then the max that you're going to be able to contribute is going to be $7,000. So that's what your limitations are. Now, these limitations, both for the new child account and for the Roth, they're indexed for inflation. So you see they change every year. You always want to look at the year that this is actually occurring. And then sometimes what happens is we need to start figuring out how do we do a strategic layer, because it's not as easy as saying, okay, we only do the new child accounts up until this age, and then we shift over to the custodial Roth, because there are other types of implications that might be able to maximize our after-tax consequence for our child. So let's go ahead and look at the strategic process. So this is our general strategy, and then I'm going to kind of make it a little bit more specific. So here's a simple rule that we have. So initially, take that $1,000 if you have a qualifying child a child that was born between 2025 2028, they have a social security number. Go ahead and take that $1,000, free money. Sure, the taxes is just deferred, it's not tax-free, but hey, it's still free money. We're still better off for our child. Then what we want to do is we want to continue making those contributions to it until our child has some type of earned income. And then once a child has earned income, you want to go ahead and shift away from those other types of planning tools, the government plan, and you want to start moving into that Roth contribution, because now what's going to happen is it's going to grow tax-free, and it's not just tax-deferred, it'll be tax-free. You're not going to ever have to pay taxes after the initial contribution that was made. So that's the best strategy for them, using that custodial Roth IRA. And then what you're trying to do is you want to focus long-term. This isn't a short-term strategy. You know, when you're looking at this type of planning, we're looking at, hey, 59 and a half years old, we have a long horizon, so we need to be focusing on it. Now, one of the reasons that you want to focus over to the Roth is because you also have more investment opportunities associated with the Roth IRA than you do with these other government contribution plans. Okay, so there are some big differences between the two. Another key thing to mention is when you're looking at these government plans, as it currently stands, there is no required minimum distribution. Now that can change because these plans are all brand new, but right now the code 530 is not showing this. Okay, but when you're with the Roth IRA, this has a longer history and you do not have the required distributions because you've already paid taxes on those up front. So you don't have that required distribution associated with it. Okay, but like I said, it's more nuanced than this. So let's just talk a little bit about it. If your employer is making contributions, hey, you may need to go ahead and stay under that government contribution. Now, you can also have that Roth contribution over there, but you would still be using the government contribution plan, the government investment plan, so your employer can continue to make these payments that you're not going to be taxed on. So it's a really nice tool used for that. Or maybe your child doesn't have enough earned income to be able to max out their Roth IRA. So maybe what you're doing is you're splitting the amount that you want to contribute between your Roth IRA for the child with the custodial Roth IRA, and then another part of it going into these government contribution investment plans for the child. The final thing I want to mention is a 529 plan, which is used for education. So that is also another really good tool that's going to be used for education. I can do a full video if you'd like me to do it on the child or on the 529 plans. But even if you're going to use a 529 plan, hey, take that $1,000 for that first year. If your child is born between 2025 and 2028 and they qualify for it, go ahead and take that because, again, it's still free money. Open that account, get them started on that account as well. All right, I hope this video helped you get a better understanding. If it did, go ahead, subscribe to this channel as I talk all things tax, whether it's tax strategy or whether it's a line by line on your 1040s or even student information on taxes and financial accounting, business law, those types of issues. So go ahead and subscribe to this channel, and good luck as you continue to work on these plans.